All right, then we hit the button. Hello. Hello, everyone. Welcome in. Get comfortable. Hit the like button. Say hello to your friends in chat. It's time to get this started. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. Welcome in. It is Friday? Friday, April 19th, 11 a.m. Great to see everybody. What's up, Lolex, CB, Metal Ants? What's up, Carpenter? B Skeet? Cedric? Robert, hello. Ben, hello. Gary, hello. I hear clear, what up? Thanks for being here, everyone. We had a bit of a dramatic day night last night, didn't we? I don't know if you were paying any attention, but in the evening time last night, there was a news report about Israel shooting some rockets over into Iran. And it doesn't really matter to me how true that is or not. The fact is the market reacted really strongly to it. And last night, it wasn't nighttime. I guess it was in the evening. It was after dinner time. And we just started seeing like a bunch of things dumping. Here was the S&P during that period of time. Was this it? Oh, it was here. Wait, hold on. I'm sorry. I'm way too zoomed in. Here it was. Yeah. This was last night. ES started dumping. The NASDAQ was dumping. We had a bid in gold. Strong bid in gold. We had a bid in oil. Wartime kind of stuff. We also had a bid in treasuries. And, it was seemed like one of those moments where everyone was paying attention to the news at the same time. And we've gotten a lot of these news stories recently, but they haven't always moved the price like that. And it seemed like somebody yesterday thought that what we were seeing was like the doorstep of World War III. And so everything started selling. Safety bid came out. And then you wake up this morning and, while equities are still down, Bitcoin, which was following that trend last night, swooped down, swept the low, and has bounced all the way back up. And it's now doing an underside retest of the 200 moving averages on the 1 hour time frame. We're waiting to see if that breaks through. But Bitcoin bounced, crypto bounced, equities a little bit weaker, not quite as conclusive, but they're coming into an interesting spot on their price charts. So a little bit less the case on the S&P, but if you look at the Dow Jones, for example, here on the daily, there was an area I drew out on one of my charts. It was a while ago. And it was this area here. And we've come right down into that spot. That kind of doesn't really matter where you draw the box, but generally this consolidation, which was the end of the year, beginning of the year, right there, right around New Year's, from Christmas to New Year's, that period of time, that's where we've now pulled back into. And yesterday during the sell-off, I think if we draw this on the futures chart, you can see it a little more clearly. Yeah, let's put this on the futures chart. You can see how yesterday we came deep down into this zone and have now bounced cleanly back out of it. And here on the 4 hour, we're just kind of waiting to see a market structure break, which for my purposes would be a 4 hour close on this time frame, would be a 4 hour close above this line. But equities bounced. It looked okay. It's kind of annoying sometimes. I mean, war is awful. Don't get me wrong. I don't want to be insensitive to those things. But here on this channel, we're talking about the markets and the economy. And it's a little frustrating, I should say, rather than annoying, when you are participating in like a community like FinTwit, and everyone's watching something happen at the same time, and they're all just so sure about what it means. And if you had asked, if you had just like polled the room yesterday at like 9 p.m. when all of this was going down, the average person would have told you we were about to see World War III. And everything was about to pop off. The dollar's going to 120. Everything's going to go crazy. And here to this morning, things have kind of cooled off. Maybe they escalate again, but I think everyone is really zoomed in on the tit for tat going on between Iran and Israel and anything that might happen over there. And it's reminiscent. It's not at all the same. So I'm not going to conflate war with like Fed policy. Those are two different things. But in terms of how FinTwit reacts to them, there is a parallel in seeing news and then extrapolating it out to the most extreme outcome and pricing that in immediately or expecting that outcome to be imminent. I'm thinking back to how, in relation to how we just saw what happened yesterday and everyone thought it was World War III, everything starts dumping. And then here this morning, we have recovered that entire move. Just like how in 2022, anytime we had any threat of maybe FX instability in currency markets, in the bond market, we had rising volatility in the treasury market. Anytime there was anything like that, people were calling for the Fed to imminently pivot and to cancel the hikes, start cutting, even though CPI was at 8%. Like people still were pricing in an imminent, like next week it's happening, imminent kind of Fed pivot. And I recall in summer of 2022, when we had the 40-year highs on CPI, the market was pricing in a Fed pivot by Christmas, which is, when you think about, when you just look back now, a year and a half, 2 years removed from that, it seems like that was an insane thing to think at the time, that the Fed would look at the CPI report and say, we need to cut interest rates and send us right back to zero interest rate policy. And I feel like, in the same vein, but for a completely different topic, the market is now taking fears about war, a headline about a rocket being shot across a border, and they're extrapolating it out into the worst possible outcome. And oh, holy shit, it's World War III. Everything's going crazy. Buy gold, sell everything. And it's just, man, people are far too zoomed in. And I really sometimes just got to put the phone down and just kind of like walk away. But structurally, talking about the price chart, if we just look at BTC here, we are red for the quarter, right? Here's the quarterly open. We sold off, tried to retest it, and we just rejected. But if we want to look at this objectively, we've shown some weakness, right? We did set a new low right here. We broke this market structure down on the daily chart. But then yesterday's price action was really interesting, because we had this low. Let me mark that out. We had this low here. There's another low a bit lower down, but there's no guarantee that it gets taken out. Maybe it still does. But if we're just going to look at structure as it is right now, we can see some positive things about it, some constructive things about it. So this is Coinbase. And yesterday's sweep actually took out the low. It actually swept the low from Wednesday and took out those stops. And it did so on what closed as a swing failure, or what is looking like it will close in a few hours. I forget, it's Bitcoin, it's not equities. What's looking like it will close as a swing failure of this level. And it might even be a pretty bullish close. It could close all the way above that candle. If that's the case, that's quite a bullish look. That's not a break in market structure. So we have a lower wick, right? Here is the pivot. This is the pivot that we would look to see, is this going to get broken? Now, in different people's systems, they may have said, well, we've seen a lower price here below this price, so that's enough to make me feel like we're going to go lower. Some people might have that perspective. But from my perspective, when I'm thinking about trading and I'm trying to analyze market structure, there is a particular rule that I adhere to that keeps me out of trouble and helps me avoid head fakes, and it involves market structure. And so this pivot, like I said, let me make it a bright color so you can tell which one I'm talking about. This one. For this to have been a break in market structure, what I would have wanted to see is a candle closing below that line like this. Doesn't matter what the wicks look like at all. Yeah. Doesn't matter what the wicks look like. They can be just little like piddly things. Oh my gosh. But for sorry, gathering my thoughts. The drawing tool here, it keeps drawing on each side of the candle, and it was like confusing me while I was trying to talk. Let me pull up a different drawing tool. Here we go. So these wicks can be like this, and that's cool. If the body of the candle closes below a prior pivot, that's a market structure break to me, no matter what the wicks do. But when you get wicks, and then you get candle bodies that don't close below that level, to me, those are swing failures. And that can be a bullish look if we get a market structure break higher on this side of the move. So if this daily candle, this is my opinion, right? This is not a rule of all markets, but this is kind of my rules of engagement when I'm trading. If this candle closes above this high that it swept here, then that's a pretty bullish look. This is a pivot. This created the swing failure. This would be a bullish close after a swing failure. That looks great to me. So from my perspective, this actually looks pretty constructive. And I tried to take a long yesterday, but I took it off of this low. Let me zoom in. I took a long yesterday off of this move, and my stop was here, which was foolish of me to do. And in hindsight, I should have set it a bit lower. And so I actually got closed out on this sweep yesterday. But I was looking for a move back up into these highs because yesterday that was the next high. That was the next pivot high. So I got left behind a little bit on this bounce, but it's constructive price action and it looks pretty good. Ethereum looks a little weaker, but for BTC, which is going to dictate the direction of the market broadly, that looks all right. But yeah, just coming back, it's not a guarantee of anything because we still have this bigger low hanging out down here below us. Oops, this one here. And we've got a couple of wicks, equally spaced, equal levels. You know, that's kind of an enticing spot to just come down and sweep that. That could certainly happen, and I'll keep my eye open for it. I think if we got that move, depending on how the close looked, you'd have to probably be pretty bullish about that kind of a sweep, depending, like I said, on how it looked. But if we were to take out the entirety of this structure's lows, which we still haven't done, and close back up above this level, then I think you'd have to be pretty bullish. But you could still be bullish now, I guess, is the TLDR of my inelegant ramblings there about the Bitcoin price chart. When I look over at breadth, it's not been looking great. So this is our momentum oscillator that shows coins rising or falling, right? And if the market's going to turn around, this necessarily will print higher values because it is the market printing higher values. This is literally coins going higher versus going lower as a big group. On the daily chart, it still is a gator jaws down. It's a wide gap, but it might be softening. And if we zoom in to like an 8 hour, we can see it looks like it wants to curl. We've got a positive cross on momentum. That means a few more coins are making highs than not. So that's a good look. If we zoom down even further, that you can see that constructive action is really developing. I'd love to see it actually form on the daily chart. And when I was looking at this yesterday, I discovered a key level on here that I think is really interesting. Where is it? Here. So let me zoom out. Here's the whole market since right before the COVID crash. This is our momentum oscillator of highs versus lows. Now, the thing that I want you to notice is where the yellow box is and how this yellow box during bullish uptrends has acted as a kind of pivot of support. Right? You see this? We rejected it here during the run up to the pre-COVID crash, or to the COVID crash, I should say, when we were still kind of in a bearish consolidation. It was resistance. We had the COVID crash. Or sorry, that's not the COVID crash. We broke above it, we had the COVID crash. And the COVID crash found this level as a kind of support. The number of coins declining found call it a support here. And that same bounce came in November of 2020, which is ironically right as we were heading up to the prior all-time high. And it started to be broken in the summer bear, which we know that was a really sharp move, it was a 50% drawdown mid-cycle. And once we got past the all-time high, the for real all-time high, that floor gave way and it became a lot more choppy. And there were times when it acted as a resistance point. You see that? You can see a lot of chop in here. You see that? Chopping around under these levels. A lot of chop, not really being able to get back on top of it. And though we had periods where price picked up, and we saw more coins making highs than not, it just returned back below this key level. Same thing over here. We saw this run up of coins, right? And then it got back below that level. And we did the same thing again. We did it a couple of times. And it really wasn't until October when we got the fake tweet about the ETFs from Cointelegraph saying they were like imminently being approved, even though it was a couple months later. That broke us above this level and turned it into support, and it has been support. So if we're going to carry this logic forward, let me get rid of all my little fuchsia brushes. If we're going to carry this logic forward, then it would suggest we're forming a low on momentum here. If this is a bull market, this should begin to curl here. It might take a few days for that to develop. It's not a perfect level. It's not literally a price level. This is just a place on the momentum oscillator where things tend to cool off and reverse in periods of uptrend, and then becomes a resistance point, a churn point, a place of supply, call it, in bearish markets. So if we're in a bull, we're at that place which is confluent with these key levels, which is confluent with these key levels on the price chart that we've been talking about. We're at that place. And on breadth, it says we should begin to curl here if this is the bottom, right? Meaning, now price action can spike. It can take some time to dig out. It doesn't mean we turn around and just go straight up. But what it should mean, if we're correct, and if this indicator is telling us the truth of it, that we shouldn't continue to bleed lower, because that would necessitate this going lower. And that just seems unlikely if we are in fact still in a bull market, because we can look back to the prior bull market when that was true. Does that make sense? I hope that makes sense to you. I think this is a really interesting look, and I'm going to be keeping an eye on this going forward. I look at this indicator a lot, and the more I use it, the more partial I have become to it, because it's just so damn good. It really sees what's going on. And I love it. So I'm going to continue to look at it. I'll keep an eye on it. And hopefully over the next week or so, we can begin to see daily structure become constructive around this area on my oscillator. Really hoping for that. Let me check in on the chat here. You guys are chatting away. General Jackass says, I'm here. What up? What up? Oscar Santana, major resistance at 20K subs. Bro, you are not joking. I have been between 19,000 and 20,000 subs for almost a year. I can't get out of it. I'm stuck there. I can't even get above 19,500 and stay there. I've been hovering around 19.2, 19.3, 19.4. I go up, I go down, I go up, I go down. I don't know who's unsubscribing. Maybe they don't like the format. Maybe they want a different kind of content or whatever, and that's cool. But I just can't seem to continue that momentum. I've really stalled out. Maybe the key is to make more pre-recorded videos. Don't really know. I don't know if the live streams are like kind of a net negative for growth. Maybe they don't really bring in new viewers. That's possible. I'm glad you guys are here, and I'm glad to have this platform, but it is kind of curious how the subs have just been stuck at 20. I remember tweeting about it in like Q3 of last year, how 20K won't be too much longer now, and I'm still at almost the exact same amount of subs that I was back then. Interesting. We're going to talk about the Fed here in just a minute. General Jackass says, thoughts on the possibility of Bitcoin getting one last pump post-halving and then cooling off for a while. Yeah, today's halving day, by the way. We haven't mentioned that. If you go to timechaincalendar.com, my Twitter buddy TC developed this. It's a really cool site. He made it look like a watch face. Let me turn off the animation so you guys don't get a seizure. He made it look like a watch face, but it's showing a countdown to the halving up here. It looks like we've got 9 hours, 56 blocks left to the halving. Block 840,000 will be the halving, will be the beginning of the next epoch. It's pretty exciting. If you want to watch it, it's kind of a cool thing to watch. From what I understand, I wasn't in Bitcoin in May of 2020 like I am right now. To the degree I am, I was more casually interested in it. So I've never actually observed a halving in real time. But what I think I'm probably going to do is go to like mempool.space and actually watch it happening and like watch the blocks flip. Because if you can go look at the transactions, you can see the block reward. Where is it on here? Maybe it's not on this screen. But I think I'm just going to watch it and just kind of tinker around. I don't know the best place to watch. I've never really tried to do that. But I just think it'll be interesting just to kind of see what happens with the market, what happens with the hash rate, if the times change on the transactions. I don't know. I'm just kind of interested to see what it looks like. So that's something I'll be keeping an eye on as we get into this evening. David Kyra gifting a membership. Thank you, bro. Appreciate it. To Matt Hebert. Matt Hebert's a longtime supporter of the channel, getting gifted another one from very generous gifter, David. Thank you, bro. Thank you. So we opened the stream talking about the war surprise from yesterday, how it caused a big sell-off in equities. We had a bid in bonds. And I think that's one aspect of what's going on that's creating volatility. And then another aspect that is creating volatility is what's going on with Fed policy and whether or not they will be able to start cutting interest rates as they have been flirting with for a very long time. So when we look a couple of weeks ago on the channel here, we looked at CPI. We looked at this table of CPI, and we noted how on a year-over-year basis, which is the red line, things like all CPI, actually, let me go look at it over here. Here we go. Year-over-year CPI, right here, regular CPI, has just been hanging out at around 3.5%. But what we've noticed, I'm going to have to jump back over to my other chart. What we've noticed is that the shorter term rates of change have been starting to accelerate. And from that big dash we looked at, shorter term rates of change are accelerating across the basket, right? Here's median CPI, trimmed mean, core services, core. And you can see the blue line on this chart is 3-month annualized. So that's if you took the 3-month rate of change and you projected it out for a year. That's accelerating a lot over the year-over-year value, kind of across the CPI basket. And that's making the Fed's job quite difficult. Back in December, when they had the FOMC, I remarked on the channel how amazing it was that Powell was being so dovish. He was like shockingly dovish. I think I even tweeted at that moment that he was giddy. Let me see if I can find that. Oh, it would help if I spelled my own username correctly. Here it is. December 13th, 2023. That was FOMC. Powell is really juicing the fuck out of this. He's positively giddy. He was so excited to see inflation because late in the year last year, inflation had been coming down. Like if you look at this chart right here of core, let me blow up this core chart. So the red line year over year, this is the number that gets reported every time we get a new report, right? The year over year figure, 3.8%. And late last year, that number was coming down. The 6-month rate of CPI was coming down into November. And the 3-month rate had been going down into August, though it had bounced a little bit. But the 6-month rate had been falling into November. And 1 month later, Powell was positively giddy at the FOMC, talking about how they're probably going to start cutting, just need a couple more prints and everything's going great. And he got too excited. And when you combined that with what happened 1 month earlier in November, where Janet Yellen surprised the market with slightly less duration issuance in the upcoming quarter than it had expected, that plus Powell being super giddy and dovish in his remarks, it got the market overexcited, and we have reaccelerated. Inflation has picked back up, yields are rising, some parts of the economy have shown a little bit more life. Some of the PMIs have shown a little bit of a pickup, even though there are still inflationary pressures. And so what that's created into the first 3 months of the year is a dynamic where we are actively watching a reacceleration of the things the Fed was celebrating slowing down just 3 months ago. And it puts them in a box because they're now trapped in a situation where they have a mandate to deal with inflation that is potentially reaccelerating. It seems to be reaccelerating. And on the other side, they have a credit market that has largely stopped moving, at least on the commercial side, because they have raised interest rates so far in such a short amount of time. If you look at commercial bank lending, it's ground to a halt. If you look at mortgage applications, it is ground to a halt. Home sales, ground to a halt. General bank lending, business and commercial loans, completely ground to a halt. It's still, there's a trickle, but it's very low. And what we've seen here, as we've looked at the rate of growth of credit, is that it has slowed down faster than any other cycle. And it's, until very recently, was still negative on an annualized rate. So we have a credit market that has been ground to a halt, and we have entities praying to living gods that we actually get a rate cut sometime soon, because they are looking at a massive gap between what they pay on their debt and what they'll have to pay for new ones. We're talking about people trying to buy homes, businesses that termed out their own debts, sovereigns who are, who have to borrow and don't dictate policy to the globe like the US. Every borrower is in a tough spot as long as the Fed is forced to stay where they are right now. And the data is suggesting that they will have to do that. So what's interesting, a couple weeks ago, one of the things that we covered was a speech by Fed Governor Christopher Waller called "There's Still No Rush." I wonder if some of y'all remember that. And so if you go look at the speeches by Christopher Waller over the last couple of months, he's been hinting at what's going on, right? At the end of the year, he said something appears to be giving. This is analysis we did here about 3 weeks ago on a live stream. He did a speech called "Something Appears to be Giving" in November, and that was when data like the CPI that we looked at were still slowing down. And it looked like maybe we were getting to a place where they could actually declare some kind of early victory. That was in November. 1 month later, Powell was super giddy at FOMC. And then you jump forward about a month or so, and Christopher Waller starts acknowledging inflation has been good, but the economy's also really strong. Are we sure this is going to last for very long? And his speech is literally called "Almost as Good as It Gets, but Will It Last?" And then a couple of weeks later, well, I guess it's a month later, in February, he has a speech called "What's the Rush?" And the rush he's referring to is the rush to cut interest rates. So in this speech, he kind of goes through, why are we in such a hurry? The economy is growing well. Unemployment is low. The labor market is still moving forward. People are still spending per PCE data and credit card data. And inflation is, generally speaking, on its way to our target. But why are we in a hurry to cut interest rates if everything is going well? That was "What's the Rush?" And then in March, just a month ago, he said, "There's still no rush." Now, this one we went through quite a bit together here on stream. We read some of his biggest points. But near the end is when he makes the real takeaway from this speech. And he says, the markets have pulled back the number of expected rate cuts in 2024. If you recall, at the beginning of the year, the market thought we were going to get 6 or 7 rate cuts, even though the Fed, in their own projections in December, projected no more than about 3 cuts if everything went according to plan. Well, the market thought it would be 6 or 7. And in a very short period of time, they have come all the way back down. We'll look at that in just a moment. But Waller says here the markets have pulled back the number of expected cuts. If you compare December projections to the ones that just came out, this was in March, we see that the median number of cuts in the Fed funds rate is still 3. But the dots, meaning the votes of the different governors on the Fed board, have moved higher, meaning that some policymakers have removed 1 or more cuts from their projections for this year. In fact, the number of people expecting more than 3 cuts decreased significantly, while the number expecting 2 or fewer increased. In my view, it's appropriate to reduce the overall number of cuts or push them further into the future in response to the data. Subsequent data might alter this outlook, but based on what we know now, there is no urgency to take the step toward easing. He was very clear. Fast forward to now. And what are we actually starting to see? Susan Collins, Boston Fed. Data warrants later fewer cuts. Just a couple months ago, she was still on the 3 cuts camp. John Williams, New York Fed. No urgency to cut interest rates. Raphael Bostic, Atlanta Fed. Rate cut not likely till the end of the year. Loretta Mester, Fed can hold rates steady, not in a hurry to cut. So all of the cronies started coming out of the woodwork. We had an IMF conference this week, so we had a bunch of them talking there. They're talking at different conferences, and you can't get away from the goddamn Fed speakers. And all of them are now coming out and supporting the idea that Christopher Waller has been planting for the last couple of months, that the data does not support imminent rate cuts. Surprise, surprise. So what happened on Tuesday? Powell finally agreed. He finally acknowledged that the data is not supportive. He had this little clip. I'm not going to play the clip because it's 3 or 4 minutes long. The main takeaway that he says in there, he calls out 12-month core PCE, and he says it is little changed from February to March. And he says we actually note a considerable lack of progress on inflation, and that it has given us more need to wait to get confidence to ease. So Powell is now on board. And the important thing for us to note is that we have an FOMC in 2 weeks. It's on April 30th and May 1st. And the tone that we get out of Powell in that meeting will be really interesting. I think we won't have a lot of economic data between now and then. Let me make sure that is true, that what I'm saying is true. Next week, we're pretty light on data. We get PCE. We get consumer sentiment, but nothing else huge advanced GDP. And then FOMC week, right? This basically day of FOMC, we get ADP non-farm payrolls, we get ISM manufacturing, and we get JOLTS, all on FOMC day. And you have to believe that when we hear from Powell on this day, he will have already seen all of these. So his tone in this FOMC will be really interesting because he will be coming into it having been given a lot of these data points a bit early, because that's the benefit of being the Fed. They don't get it weeks in advance. They might get it a day or 2 early, depending on the cadence of that report. So it's very likely, in fact, it's probable that by the time we hear from Jerome Powell at the pulpit 2 Wednesdays from now, that he will have new data in hand, and he will have this tone of a delay in rate cuts. And I will be fascinated to pay attention to that and to analyze it. It's not because I get asked sometimes like why I pay so much attention to what the Fed says, because, you know, usually when people ask me why I pay attention to what they say, they usually follow that up with something, some kind of characterization of the Fed. Well, you know, they're just juicing all the data points. Everything's fake anyways. It's all just, they're just trying to make us poor so that they can enrich the cantillionaires, whatever people say. And there are elements of truth to those statements, but they aren't strictly true. And what the Fed says does matter because they are a big, stupid organization. And what they are thinking has a big fucking impact on financial conditions and the economy. People don't think it does, but it absolutely does. They control some of the biggest levers in the world economically in that little building, the Eccles building in Washington. And the reason I think it's important to pay attention to what they say is because it gives you insight into how they are viewing the data in a very difficult cycle to interpret. And if you separate what the Fed has been saying that they wanted to do all along from the market's interpretation of those things, they've been very different at times. The Fed has actually, since 2022, since we began hiking, the Fed's been remarkably steady. Now, that's going to sound like a compliment, and people who are very emotional about these topics are going to interpret that as me being like a Fed apologist. But hear me out here. Since the beginning of the rate hiking cycle, Jerome Powell has done everything that he said beforehand he wanted to do. He has not surprised the market with a policy decision at any point. In fact, he's gone out of his way to ensure that any time he makes a policy decision, the market knows what's coming beforehand. They use their forward guidance tools extremely well. It's annoying how well they use them because we're constantly having to listen to Fed speakers. And in a way that is on purpose. They want to send messages that over time drive the market gently towards the outcome that they think will ultimately be coming anyways. It's a lot easier to enforce monetary policy when the market does the work for you. This was one of the discoveries of economic research, particularly during the Greenspan era. This was not common knowledge back when Volcker was around. In fact, back then, there were not even press conferences when the Fed changed interest rates. They just did it, and you read about it in the newspaper. But when Greenspan came into office, he introduced the concept of prolific forward guidance and talking your ass on the pulpit. And so they've done that very well. And at no point has the market been surprised. Even in June of 2022, when the Fed suddenly decided they needed to raise 75 basis points and they hadn't really been talking about it, what did they do? They leaked the story to Nick Timros at the Wall Street Journal, and he published it 2 days before the FOMC, and everyone fucking priced in 75 basis point raise. Like, they are going out of their way not to surprise the market. They're holding back on making big decisions. Powell's tone may change, but what they actually are doing is very measured, and it's been very plodding and methodical. And if you listen to the market, kind of like what we talked about with the overreaction to the war news at the beginning of the stream, every single new data point, every news story, according to investors, is cause for dramatic change. And that is a huge bifurcation. And it's just, you can see that when you look at the projections of Fed cuts for 2024. The projections in December showed 3 cuts of roughly 75 basis points in total to the Fed funds rate for this year. But the market said, we don't believe you. We think you're going to cut 6 or 7 times. And they priced all of that in during a massive Q1 rally. And the whole time the Fed was going, that's not what we said. Christopher Waller's coming out with his speeches. Loretta Mester's coming out and saying, we don't want to have to stop QT. We're probably going to taper it soon, but that actually means we want to keep running QT. Well, the market took that as, oh, it's dovish. They're going to quit QT. Oh, they're going to cut. They're going to cut all the way back to 0. The debt burden is too high. They got to cut to 0. And all of these things have been wrong interpretations. So once again, here we are. And the market is now thinking the Fed's never going to cut. They're never going to cut at all. We're going to be stuck here forever. It's just wild. It's been a wild cycle as an observer, because at the end of the day, the data is what matters. The economic data, what's happening in the markets, what's actually priced in is what matters. The expectations versus what we get hit with in reality is what really matters, that delta. But listening to the Fed talk through this process, listening to the mixed messages and how they've shifted from kind of agreeing with Powell to starting to come out and say, listen, guys, I don't think we should cut rates, to the point that now Powell actually agrees. It's been fascinating because they haven't changed their policy while they've done this. We're watching them kind of deliberate about what the right thing to do is out in the open, while not changing any of their policy, while continuing to sit at 5.5% interest rates. And I think that if you look, you see what's going on with CPI, you see where is Atlanta Fed GDP now? It has ticked up back up to 3%. They're kind of stuck in a box, and they're not going to get signals to cut interest rates as long as these dynamics persist. This is an awesome cycle to be a studier of financial history and business cycles, because we're in a doozy of one right now, friends. This is the kind of era people end up writing a bunch of books about. The same way people wrote books about the GFC, people wrote books about the 80s with Paul Volcker. It doesn't mean that the recession has to accompany it. Just a period of intense change and volatility. And the last 3 years have been that to a T. We're still living through those things. In terms of the recession, the tracking of the recession, the signals there are mixed. So if you had asked me 6 months ago, my confidence level that a recession was likely within a certain reasonable time frame that we could guess, I would have had really high confidence. I probably would have been like at 75% confidence, just because of the compendium of data that supported that view, not because I want it to happen. But now we've moved through a lot of the period where we've seen recessions begin in the past. So if we look relative to the yield curve, here's where we are relative to the yield curve inverting, and we've passed a lot of the recession beginnings that happened when yield curves inverted in the past. And 2007, 2008 is the only one out ahead of where we are by about a month. And that's when the recession begins. So that isn't always like an event that happens. When the GFC recession began, it was December of 2007, and no one believed that we were actually in a recession for like another 5 or 6 months. So the fact that we're looking around and we're not sure if we're in one doesn't mean we're not. However, we have pushed through most of this time period relative to the yield curve inverting, relative to that time anchor. But if we then use the time anchor of Fed tightening, which is something that exists in all cycles, whether we have recessions or not, there is still evidence of downturns occurring ahead on the timeline. Several of them, in fact. And from this perspective, the beginning of the GFC is a whole year and a half away by this perspective of the time anchor of Fed tightening. You see how it changes the window. That's why it can be so difficult to say, well, I think a recession should start here. And though I've made the attempts to do that, partially through learning and also in an attempt to increase awareness for others, I've tried to kind of box in a reasonable area of time to think that a recession would be dated starting in that window. And that window was the first half of 2024. We're still in it. We're at late April in the first half of 2024. This is a window of time when we see those things occur. But I think it's also worth considering, as I've touched on in the past, that we are in a cycle with some uniqueness. I'll just put it that way. We're in a cycle with some uniqueness because of the pandemic that was just 4 years ago, because of the amount of money creation in the pandemic, because of the dynamics it imposed on the economy. Right? We closed down the services sector. We locked everyone in their houses. We gave them a whole bunch of money, and we said, just go spend it. They termed out their debts. Homeowners termed out their mortgages. Businesses termed out all of their loans. And then the Fed started raising, another year later. And that sequence of events has, I think, elongated some of the response functions in this cycle. And I've tried to tweet about this because it's an idea that I've had in my mind the whole time we've been studying this, but it's been really hard to articulate that. And I'm trying to articulate it so that it doesn't seem like it's a moving of goalposts, because nothing has changed, right? Like the chart is what it is. But the truth is, the unavoidable truth is that we are now breaking record after record after record of recession signals, quote unquote, triggering, and no recession being obvious. And some of those triggers are breaking time records, like in terms of how long they've been going on. Some of them I've written here. Biggest fall in full-time workers ever without a recession. Biggest rise in unemployed people. Not the unemployment rate, the number of people who say they are unemployed. Those are different things. Biggest rise in unemployed workers ever without a recession. Biggest increase in part-time workers relative to full-time in history without a recession. Longest stagnation in real retail sales ever without a recession. Fastest, deepest slowdown in bank lending ever without a recession. That's the chart I showed you here. This one. Biggest year-over-year drop in federal tax receipts ever without a recession. Longest streak of manufacturing PMIs below 50 ever without a recession. Oh yeah, by the way, that just changed. Manufacturing PMI is now above 50 for the first time since October of 2022. After 16 months. If you look back at every time that this thing ticked, there's only one other time that it did, and it was back here, and this was the Korean War. That's the only other time we had a streak anywhere close to this and no demonstrable recession. But we broke this record. Longest yield curve inversion ever and no recession. Longest streak of negative leading indicators ever and no recession. In a cycle where the Fed was later to arrive with hikes than ever before. The Fed started raising interest rates after parts of the cyclical economy had peaked. That is abnormal for almost all cycles. The Fed started raising interest rates when unemployment had already returned to cyclical lows. That was when we got the first rate hike. That has literally never happened. So from my perspective, it goes one of two ways. Either we're watching the engineering of the greatest soft landing in financial history, and it's still playing out. Or this is the biggest, baddest cycle anyone's ever seen, and we're still not done with it yet. I lean towards the latter, but I'm open to either one. I would love for this to be a soft landing. I would love for us to not have any rise in unemployment. I would love for housing affordability to come back down from the stratosphere and actually to a place where people can afford homes. I would love for groceries to stop rising at 3, 4, 5% a year. I'd love all of that stuff. But I suspect with the number of factors that they have to navigate, that the risks are still weighted towards recessionary outcome. It's just been hard to read, and we're not just going to be able to point at a day on the chart and go, it should probably happen by this point, or it's not going to happen, because the uniqueness of this cycle creates dynamics that are hard to read. The Fed arriving later than ever. The reason I think that's important is because if you consider this, when the Fed begins raising interest rates, that changes the cost of money, right, in the economy. It actually has an effect. And so if the Fed arrives later than usual in an expansion, which they did, and they begin raising interest rates and increasing the cost of capital, the effects of them increasing that cost are also delayed, because you're doing it in the middle of a roaring cycle when there is a lot of strength, there's a lot of cash floating around, there are healthy balance sheets. It's at a you're starting it at the tip of the spear. And it takes a long time for those things to work their way through. You know, in prior eras, the Fed would raise rates for about 2 years, and then they would stop, and then we would get a recession. And that's how that pattern has played out a bunch of times. Well, the Fed raised rates for 16 or 17 months in this cycle, and they did it late, and they did it very quickly, and now it's over. And, you know, assuming now it's over, I seriously doubt they're going to raise interest rates again unless something blows out. But if the people who control the cost of money, which then feeds into the slowing down of the economy, if they show up late, then the effects that they impose on the economy will show up late. And we created a Frankenstein economy with all the fucking money printing. So we created like the strongest economy we've ever had, and then, oh yeah, by the way, we were late to show up to slow it down. Is it any wonder why it's been so hard to read what's going on? I don't think so. In fact, it makes perfect sense when you consider everything I just said. Oscar says, I know it's not financial advice, but in a hypothetical situation where recession hits and broad markets go down, how would you protect yourself? That's a tough one, because there's not a safe. If you go through a recession, if you go through an economic downturn, there usually isn't a safe haven that comes out completely unscathed. Even in the great financial crisis, gold fell about 35% before it bounced. It bounced before equities and started climbing higher. So if the way that I protect myself, the way that I've been kind of slowly preparing for a potential surprise is in the balance of cash that I keep relative to normal times. Yes. I've increased my allocation to gold last year. I'm really glad I did that, because it's been going higher now. I didn't predict that it was going to scream to all-time highs, but I increased my allocation to metals, right? I'm making sure that I have paid off as much of my debts as possible. That's where I've protected myself. I want my balance sheet to be as resilient as it can be. I'm not that concerned with finding the asset that's going to go up in a nightmare scenario, because that doesn't really exist. It's about managing drawdowns. If you are going to be in financial markets for any length of time, as an investor, as a trader, as a left curve speculator, whether it's a casual thing or you do it every day or you're somewhere in the middle, everybody, without question, the thing they have to do is ensure their own survival. That's rule number one. You must survive until the next day with your capital, or you can't play anymore, right? You have to keep your account alive. And over time, gains will come. If you are simply in the market, you will gain from the market. So it's not as important to pick the right thing to put your money in all the time. What's most important as a trader, as an investor, is to limit your drawdowns. If you can limit your drawdowns, but not even be very good at maximizing your gains, you will do fine. You will do better than most people. So that's my perspective. You guys know me. I'm very pragmatic in things. I tend to try to minimize my risks whenever I can. I'm a family man. I have people who rely on me. I have property that we need to keep so that we have a place to live. I have things to protect. I'm not a young man anymore. And so it is vitally important that I limit my drawdowns. And so, if that means slowly reducing my exposure on the way up, making sure that I have a healthy cash allocation that is getting the maximum cash rate that I can find. If you guys still have a bank account and your deposit rate is like sub 2%, you are getting fucked. You should go open a bank account today. Just Google savings account deposit rates and find a bank with a better rate. Move some money over there. You should be getting 5% on your savings minimum. Some places will give you 5.25%, 5.5%. You should be getting 5%. And if you're not, you're doing yourself a disservice, because that will, at minimum, help keep you at a pace, generally speaking, with CPI. Generally speaking, it's obviously hard to calculate. So that's my response to you, Oscar, is rather than trying to find the killer trade, because look, when everything is cheap, you will find opportunities. What I want is not to nail the short. What I want is to be as liquid as possible when the bottom comes, so that I can go fucking shopping. Gonna put those puts on Nvidia. Let's check on Nvidia today, man. So before I even look, I brought it up because before the stream I was looking at FinViz, the map of today's changes, and I saw this. I don't know if they had a news story related to semiconductors. I know TSMC had some news the other day that wasn't great. That's probably what it is, because it looks like it's the whole sector. But let's go look. Let's just take a quick peek at Nvidia. Ooh, lower high. I guess it was, friends. So back when Nvidia looked like this, I was wondering if we were printing a lower high, because we were in the retracements. And I was like, oh, that's a lower high. If we break below here, that's ugly. Well, it went a little further than that. This is where I thought we were going to set a lower high. We went up and pushed higher. But then what did we do? We set a lower high. And then here we are setting a lower low. And this is a market structure break. So if you recall earlier in the stream when I was giving you kind of my like rules for how I think about market structure breaks, I think about them from candle closes, right? And so if we just go up to like, this is like an 8-hour chart, which is basically a 1-day chart in equities. Here are the two pivot lows after this breakout, right? After we broke to the upside here. And we haven't broken any of those levels. We wicked below them, but all these candles closed above both of these levels, actually. And they did so over here. Even this one closed above it, see? Until today. This is today. This is Friday. We're now cleanly below these levels. And assuming the daily closes like that, that is a clean market structure break to the downside after a lower high. I don't know where it goes, but that's bearish market structure, and we should maybe expect Nvidia to continue down lower. Maybe it's to here. If we're just kind of looking for the next place on the chart, all right, there's not really a lot here. It's just a flagpole. So if we're not anticipating price to go all the way back down to Hades, then it seems to me this is the next stop. You could maybe make the argument it's right here, but this just seems a little flimsy considering that the top of this structure was just broken to the downside on what will likely be a closing basis. So I think it's more likely that we come down into here. Which, how much more of a drawdown is that? That's another 10%. 9% on Nvidia. JB Estrada says, are you even 40? I am exactly 40. I turned 40 last year. Andy Philpott says, Wealth Simple has good interest rates on savings, 5% and up to 15% for staking. What do they let you stake? I've never used that product. I don't know anything about them. But yeah, 5% on savings is what you should be getting. And if you're not, there is very little friction to you opening an account on the internet and moving your cash today. You don't have to go to a bank physically to do it. I know that keeps people from opening bank accounts sometimes, thinking that it's going to be a big hassle. It's a lot easier nowadays. I opened an account at Citibank, which is not my normal bank, and I'm not recommending them. That's just the one I chose. I opened an account at Citi last year, and I had money in there within an hour. I opened the account, moved the money over, it was there, and boom, I was getting 4.5%, 5%, whatever the rate is. So I highly recommend that you guys do that. Let's take a look around here, make sure we have the lay of the land. Probably start wrapping up the stream here shortly. I don't want to have an hour and 30-minute stream today. So the S&P on the weekly is pulling down into the 1221 EMAs, which I like to look at sometimes for momentum. We're seeing a bearish cross on this time frame. And the last time we had one of these was this period of time here, and that led to a 3-month correction. So I don't know if we're going to see a 3-month correction here, but that would take us into June if that was the case. Well, did this start in April? April, May, June? Yeah, so that would take us into June, maybe July, if that was the case. It looks similar on the Dow Jones, in fact. Bearish cross, though this is a cross on momentum. The actual EMAs haven't crossed. The S&P they haven't crossed, but they have on the daily. Yeah, that's what I was getting confused about. They've totally crossed on the daily. You can see by the fact that they're below the median line here, down here on the MACD. So I don't really know the depth of this pullback. A lot of it's going to have to do with macro. But if you just want to think about liquidity, there is a massive amount of coupon issuance coming up here in the near term that is going to play a role on the ability of risk assets to continue moving higher. Let me see. Net coupon issuance. Andy Constant tweeted about this recently. I'm going to find the number. Since 2024, 0201. He said it sometime. There is a 1.5 trillion of net coupon issuance projected for the remainder of the year. Coupons are anything 5 years or higher in duration. So the part of the way that Janet Yellen has been able to play liquidity games for the last several months is by issuing more bills. That's what she did in November that goosed the markets and put in the Pico low, was an announcement from the Treasury that they would be issuing slightly less coupon issuance for Q1. Well, that bought them some time, but now for the rest of the year, there's a whole lot of it. This is net issuance, meaning new issuance, new money that will not be in T-bills that the market will need to absorb. That will likely put higher pressure on yields, which all else equal should put downward pressure on risk assets. So that's informing my general thinking about this correction, and how if we have a 2 to 3 month correction, that would take us through the end of this quarter, and we're in a quarter where net issuance starts picking up a lot more. So it's kind of all coming together, right? Now we entertained at the beginning of the stream, we entertained the idea that the Dow Jones had come into a support area, and that's possible. It could hold this, it could chop like this for 3 months, or it could reject. I mean, it could do all of those. If it did this, that would still be in line with what I just said about issuance, about underperforming, about a multi-month correction. This is a correction. The same way that this is a correction. The same way that is a correction. Going sideways after a period of going up is a type of correction. So we could get that. Maybe we set a lower high, we come back down, and then we chop around and we do one of these. Maybe it's like that. And by the time we get to the end of June, we're bouncing out. Who knows? That's just one possible scenario, but that would fit with what we got last time back here. Check on BTC. BTC still looking constructive. Let's go down to the 1 hour chart. Yeah, I think we're still in the weekly range. This is the Monday range right here. We got that strong reclaim of it. We're at the midpoint. So the next spot to look for is this. This was going to be my trade that I said I got stopped out on last night on this dump. I was trading a reclaim of the Monday range targeting the mid and the high of Monday. But I got stopped out right here, and I'm not in this trade. But looking at it, it looks pretty good. Maybe we come back, we back test this area right here, and then we go higher. I don't know. I'm just kind of rambling here. This isn't alpha for you guys. Oscar says, do I mind sharing anyone I find interesting to follow? Well, I guess it would depend on what you're interested in learning about. I have varied tastes. So, you know, if you're looking for financial history, I can probably help you with that stuff. Yeah, I don't know who you're looking for, but I did recommend a couple people I've recommended before. So Andy Constant is a good follow if you are interested in learning more about like plumbing stuff. If you're like, I want to know what's up with the reverse repo? Why is everyone talking about the treasury? What is this like issuance stuff? He does a good job of covering that. Bob Elliott worked with Andy at Bridgewater. But Bob is a great macro follow. He does a good job of posting what's going on in the economy and how he's thinking about it. And he's a very pragmatic person in the way that I am. And so I really enjoy Bob's takes. And I tend to try to read whatever it is that he's posting, because a lot of times I have a similar view, but maybe I haven't looked at the data the same way that he has. And so I've learned quite a bit from him. That's just a couple of people. They're not the best people on Twitter to follow or anything. They're just the first two who came to mind when you asked. Close some of these. All right. Let me close off all my Bloomberg stuff here. So the real takeaways for the Fed. The Fed is in a tough spot. We've got CPI reaccelerating. All of the Fed governors have acknowledged it. And now, as of Tuesday, Powell has also acknowledged it. This is during a period when we have GDP now at 3%. We're seeing nominal retail sales ticking higher, even though inflation-adjusted retail sales is not. Nominal retail sales is ticking higher. Industrial production is not doing anything. But we have retail sales ticking higher. We have PCE ticking higher. We have GDP ticking higher. And we have yields remaining kind of robust. I think the Fed is going to be in a tough position for the next few months. The FOMC that we get in 2 weeks, like we talked about, will be on a day, this day right here, of incredible economic data. This is a doozy of a day right here. ADP, PMIs, jolts, back to back to back. And I can imagine that when we hear from ye old Jerome right here, he'll already have seen all of this and have built it into his speech. And that will be fascinating because it will set the tone for the market, who is wanting to know. They're very confused now. For a while, the market thought we were going to get 7 cuts. Now they have priced all the way back down to 1, and they just don't know where to go. The Fed has kept the same projections, and we'll get new ones in June. We'll get new ones. Is April the next time we get a projection? Let me see. FOMC. When's the next time we get a summary of economic projections? Meeting calendars and information. March, April, May. Okay, so no, it won't be this one. It'll be here. We'll get another one in July. Okay. Never mind. I was going to say that I thought it'd be interesting. We might get an updated set of dots, but we actually just got one of those last month. That's correct. Still showing the same amount of cuts. So we'll see. We'll see where this goes. Bitcoin looks constructive. Equities look less constructive, though they have bounced today. And the momentum is firmly to the downside. The last thing I wanted to show, I'll touch on this because I had it in mind and I just forgot to open it when I was talking about equities. We're talking about how the S&P looks weak on the price chart, and that is inarguably true. Same thing for the NASDAQ. It looks even weaker. And the breadth inside of the NASDAQ is awful. So we've seen a complete breakdown of stocks above their 20-day moving average. That's here in blue. We're still seeing a breakdown of stocks above their 50-day moving average. And this momentum oscillator works in the exact same way as the crypto momentum oscillator. I built it that way on purpose so that I can compare them. So this crypto one that we spent a lot of time talking about, this is it for the NASDAQ. This is what it looks like. It's still widening and it's pointed straight down. And it looks like it's got some room to run down to what has been, area of support. At the same time, we're waiting for this metric to bottom out, which is something it normally does. If we just kind of look back through time, it tends to bottom out down here in the 0 to 20% range, the number of stocks above their 50-day moving average. So it looks like, just in terms of breadth and momentum inside the NASDAQ, that it looks like it needs a little more time to establish a floor. If it turned around right here, it would kind of be in no man's land, and this is not developed positively yet. Maybe it reverses sharply here, but the reason that this reversed sharply here is because the price chart had a sharp drawdown that took out lows. So that's how we print one of those on this chart. A quick reversal is a sweep of structure. So those are my thoughts on the NASDAQ. The S&P breadth looks identical to this. This as well looks identical. And we're looking at both of those price charts and wondering where the floor is. Maybe the floor is not quite here yet. Do I agree that they paved the way for at least one cut this year? I don't know, and I don't think one cut even matters. What matters is the shift in policy. Because when you cut once, that carries an implicit package of future cuts. There's no one rate cut. It is one in a future series. And I think that in an election year, they don't want to be seen as political. And so they are going to likely, in my opinion, do everything they can to avoid picking a side. If they were to ease without clear and inarguable evidence that they should do so, if they were to just start cutting rates, then they would be seen to be supporting the administration. If they got overly hawkish without a motivation, they would be seen to be supporting the challenger. So that's not a scenario the Fed wants to walk into with the potential of a new administration showing up 9 months from now. That is not a world they want to live in. So I think it just makes it even more likely that they wait for an obvious reason to need to cut. And if we're going to keep running 8% deficits with full employment, it might be a few months. So, okay, that's where we'll wrap it up today. If you haven't hit the like button, please do so. Subscribe to my channel if you are a new viewer. Next week, we will do a member stream next week. It's the second to last week of April, but April ends early in the week afterwards. So when we do our stream, we'll do a stream probably on Sunday, but on Sunday, we'll do a bit of a history lesson. I want to talk about Paul Volcker and him slaying the inflation dragon. There's some things I want to talk about with that. And then when we do our stream later in the week, which will probably be Thursday or Friday, tentatively now I'm thinking Thursday, then we'll do the member stream there. So make sure to show up for that, come hang out afterwards, and we'll shoot the breeze and, do what we do. Been kind of a quiet chat today. I hope you guys are doing well. We're in a period where the signals are unclear. We talked a few days ago about how Bitcoin on chain looks a little overheated. Equities are pulling back. but maybe Bitcoin is trying to establish a low. You know, the signals are mixed. The Fed is caught in a trap. They want to ease, but they don't want to ease too soon. Inflation is sticky, so they really can't ease. Other central banks around the world are waiting for the Fed to cut so they can fucking cut. We're in a waiting period, and I think the way that risks get elevated in these scenarios is because when everyone's waiting, no one really takes action, and volatility can become compressed. Now that's hard to say with the last few days of this big sell-off, but you know, if we kind of settle into a period where there's not a lot of big economic data coming out, there's no big change in policy, there's no real change to the economy, equities have cooled off and they're not stealing the spotlight, Bitcoin's not stealing the spotlight anymore. If we kind of run into one of those periods, volatility everywhere can just start compressing, and that can open the door for a really sharp move on a relatively innocuous like news story or something like that. So that's kind of something to be paying attention to as we potentially settle into an area that might need to be churned through after the volatility of the last couple days. All right. That's my last word on the economy and the markets for today. I thank you guys for being here. Appreciate your support. Appreciate you being subscribers and members and donating and doing all the amazing things that you do. Thank you so much. We will do another one of these on Sunday. It'll be a chill stream. I might not even open a single chart other than to reference talking some history. But what I really want to do is explain the situation in the early 1980s that Paul Volcker was dealing with, and how I think Powell trying to imitate Volcker may or may not be appropriate for today and the situation we're currently in. I think there's some interesting things we can look at and talk about, and I can even read you some of Paul Volcker's own words about when he was dealing with inflation in 1981 and 82. Really fascinating stuff, in my opinion, fascinating stuff. And I think it'd be fun to just do a stream about that. So that's what we'll do on Sunday. Until then, take care of yourselves, friends. Take care of each other. I hope you enjoy your weekend. We will meet back here in a couple of days. I will book it early tomorrow so you'll know the time. And that's where we'll leave it. So I hope you have a great Friday. Once again, thanks for being here. I'm TXMC and I'm signing off. Cheers, everyone.